This is Radio Now 95.3 FM. Come for the news, stay for informed conversations.
The federal government, through the Federal Inland Revenue Service, has imposed a 10% tax on interest earned from short-term investment payments. The new rule also implies that investments in Treasury bills, corporate bonds, promissory notes, and bills of exchange will be subject to the tax. Joining the conversation now is Muktar Mohammed, who is a finance and economic expert. Good morning, Mr. Mohammed. Thank you for joining us on the conversation.
Thank you for having me. Good morning.
Right. Could you start by explaining to us what this new directive is about?
I think it's also all about the tax, when I say the tax regime that we are going into. Before now, short-term instruments are not taxed. The interest on them are not taxed. So what this new law is saying is that if you have, like before, if you have a treasury bill, if you have been paid a treasury bill, you are not taxed. What it means you have tax exemption. All the profit, the interest due you will be paid to you directly. So what this new incentive is saying now is that, let me say your interest is 100,000 like it used to be before. Now it will be 100,000 minus 10% withholding tax. You are not going to get the whole 100,000. And before now, these are also paid upfront. So in your payment upfront, taxes will be deduced from it. That is exactly what it means.
So speak to us, Mr. Mohammed, about whether, I don't know, is this a good idea?
It's not a good idea, to be sincere. When you know that, again, we have the capital gain tax coming, you are not bringing the withholding tax. And my fear is that most of the people that play the retail side of the investment are looking for safer investment are the retail investors, and they are ordinary Nigerians. They are looking for ways to improve their income and by investment. So this also will discourage a lot of investment. And what it means now is that when you see returns of maybe the companies are giving returns, that means again it's going to affect the returns. So it's not going to attract so much investors really wanting to invest, especially like I say, the retail investors, the small investors. It will also affect other corporate companies. And if you look at the bank's balance sheet, you always see that income that comes from security investment. So what it means also, that will also have a negative effect on our financial institutions that are already dealing with the high imperial charges due to non-performance loans.
So I'm looking at, when they break down what and what will also be taxed, I think about Treasury bills, and I may be wrong. I'm hoping you will correct me on this. Treasury bills in many ways seem like mid-term investments, if you like. And it strikes me that if the government is going to tax this, it's almost as if they're still trying to eat from what it is they needed in the first place to finance or fund whatever it is, whatever project it happens to be. And usually the argument for taxing short-term investments is that it will encourage people to invest in long-term opportunities instead. Are we likely to see that change happen? Do you think that Nigerians will trust now that government is coming to tax things such as treasury bills?
No, I don't think it is going to. It's going to really, in my opinion, might drive a lot of retail investors. That are the smaller investors, like you said, those that are looking for interest for maybe less than even 500,000, 1 million, and others. Those are the ones that will be affected. And what we'll see is that a lot of Nigerians that see this investment as a tool to increase their disposable income are now at danger of losing that disposable income that they normally would have had. So it will not encourage any long-term investment. Like you said, Treasury bill is a short-term instrument that a lot of people use for short-term projects or to beef up one area or the other. So for me, I don't think it's something that at the timing of all these are even wrong, very, very wrong. Especially when you have the new tax law coming into effect in January, and then again looking at what they are saying that you also at the end of the time, if you don't agree to it to be your last tax, then you also be reformed all the amount. I think that's what the FIRS is saying also. That is like what is done in developed economy, what they call it tax credit. We have those systems. That is my challenge. It's involving a lot of bureaucracy. I can give you one. Now, the Security and Exchange Commission said that any dividend that was not collected after 6 years should be returned to them, and then they will invest it and in turn give the investor. Nobody told us how they are going to invest it. Nobody told us the modality to retrieve those investments if the owner comes to get it. So these are all type of bureaucracy. These are type of policy that are not clear cut out before implementation, and that has a way of affecting investors' confidence.
Mr. Mohammed, is there any, do you see any way that investors can, I guess, perhaps the word here is push back against this particular directive, especially when you consider the negatives that we've discussed in this conversation?
Well, we have to wait for the next auction and see how much people will participate. Like I said, there's still going to be a lot of pushback from investors. And one of those pushback that you won't get the kind of participation that you usually would have gotten, because my interest, my income is less than 10% now. So definitely we are going to have, it's going to be more low returns. Yes, it may encourage long-term investment, but how long is this long-term investment? Like your colleague said in the studio, Treasury bill, corporate bond, and others are always short-term instruments for specific projects. So definitely you can't say you want to do Treasury bill, 5 years Treasury bill, 10 years Treasury bill. Treasury bill are always either 100 and 180 days, 90 days, or 365 days. So there's no Treasury bill where you get to say, oh, it's a 2-year Treasury bill. What happens is that after the 1 year, you might think of rolling it over. And so that is how Treasury bill works. So now, what it means is that most companies or individuals will not have those short-term funding that they normally use to augment against their income.
So, for the sake of our listener and for, I guess, historical perspective, the trend we've seen recently in the past has been that Treasury bills tend to be oversubscribed. So you can see a large investor appetite, and largest contextual here, just based on when the government puts out the offer, they then get an oversubscription that they were not planning for. And, you noted that it would hurt short-term and, smaller investors. So someone like myself, for instance, if I wanted to invest in Treasury bills. In the last 2-3 years or so, maybe even up to 5 years, we've seen regular Nigerians going to take more and more interest in investments, and especially in things such as the Nigerian Stock Exchange, government offerings, bonds and whatnot. I'm curious as to how we balance what you are expecting. So you're expecting that people will have less of an appetite for investing. But if we're going to encourage people to invest more into what essentially builds the economy, what do we need to do to get regular Nigerians and not so much the big investors on board?
The only way you get regular Nigerians to want to invest is in the extent of returns. And that's why you see the Treasury bill space is always oversubscribed. Because, like I said, most regular Nigerians participate in that because of the risk-free nature. Not every Nigerian knows how to take risks to come to the equity market, the stock market. But the Treasury bill space, the bond market, these are safer investments. And so definitely that is why they want to play that space. So what you see, the only way you can encourage more Nigerians to now begin to think of long-term investment is to also begin to enlighten them education and let them know the benefit of the long-term investment, that it will be free from tax. Remember again, that long-term investment are not going to be totally free from tax when this new tax law comes into effect. But then if you are not doing up to 150 million, then you are free from it. So the capital gains tax. So I think what we'll see is that a lot of Nigerians who are interested in investment will begin to see how they can begin to invest in long-term instruments, if that will improve their disposable income. But again, that also is depending on the project you want to do and the risk level that any individual is ready to take. Like I said, the fixed income market, which is the Treasury bill space, is a safer means of investment, virtually risk-free, which most Nigerians want to participate in.
Mr. Mohammed, thank you very much for your time and expertise on this conversation. Muktar Mohammed is a finance and trade expert who joined us here on Now Breakfast to speak on a new rule by the federal government Through the Federal Inland Revenue Service, they've instituted a 10% tax on all short-term investment payments, and that includes Treasury bills as well. Beg your pardon, that includes everything from Treasury bills to corporate bonds, promissory notes, and bills of exchange. You're still listening to Radio Now 95.3 FM Lagos. We urge you to stay tuned. The conversations continue on Now Breakfast.
This is Radio Now 95.3 FM. Come for the news, stay for informed conversations.